Are you an entrepreneur making less than $350,000? Today, I talk about tax strategies you can use to reduce taxes in your 2018 tax return. Previously, I talked about entrepreneurs who make less than $100,000. Even if you make above that amount, I do recommend you watch that video because there's some things you could learn. In this video, I specifically talk about situations in addition to that might limit those deductions for an income earner who makes $315,000 if married jointly. So which means you and your spouse makes $315,000, or if your single filer makes about $157,500 and above. I'm sure by now you've heard of the qualified business income deduction. The qualified business income deduction is also known as QBI deduction, is 20% of your QBI income. What is your QBI income? For most people, it'll most likely be your net income. So when taxable income is below $315,000 for a married person and $157,500 for other filing status, there's nothing to worry about. But however, problems and complications starts happening when you go above this amount. Let's talk QBI limitations. But first, before I do that, I need you to understand what a specified business is. The rules change depending on whether or not you're classified as specified business or your other general businesses. So what is a specified business? A specified trade or business is a business involving the performance of services in the fields of health, law, accounting, consulting, financial services, brokerage services, or any trade or business where the principal asset of such a trade or business is the reputation or skill of one or more of its employees. In other words, if you're a service business where the business depends on you, you are the business, you are a specified business. So if you're not a specified business, then you're a non-specified business. A general business, what I like to call it. Basically, you don't meet this definition. As a general business owner, I would like to take a minute to talk about your limitations. If you make over $315,000 if you're married, $157,500 if you're single, the QBI deduction is subject to phase-out limitations. However, it's at $415,000 for married and $207,500 for single. Your QBI cannot be more than 50% of your wages, or the sum of 25% of your wages plus 2.5% of your unadjusted basis. And basically, unadjusted basis is the original cost you bought your assets. So let's look at a 50% of wages limitation. Here's an entrepreneur making about $350,000 a year. Without paying wages, he owes $96,198 in taxes. With paying wages, he pays $85,963 in taxes. This is a $10,000 difference. So if he was not going to pay himself wages because of his above that income threshold, he does not get the QBI deduction. Let's take a look at what this looks like. Same situation, only difference is he took $50,000 in wages. So that's the 50% limitation. He can only take the maximum of 50% of his wages, which is the $25,000, since it's above the threshold. So 50% of $50,000 is $25,000. And that alone brings his taxes down by $10,234. So now let's make the assumption that this business owner has $1 million in assets. So that means sitting on his books right now, the cost of what he bought this asset, less all the depreciation he's taken over the years, is $1 million. Well, he gets to get 2.5% of that plus 25% of his wages if it's higher. But if the 50% of the wages is higher, he gets to get that. But in this case, the 2.5% of unadjusted basis plus 25% of wages were higher. So we can scroll down here and we can see the test that he gets $37,500 of QBI. Now here, when he paid no wages or did nothing, he gets zero, which we had talked about before, but now he gets $37,500. This brings his tax liability down to $81,588. So that is a savings of $14,609. Same situation, only difference is you've chosen to pay wages versus not take wages. Now, as a specified business, you don't have the wage limitation like the non-specified business has. As a specified service business, if you're above the threshold and your income reaches the $415,000 for married filers and $207,500 for single, you don't get the QBI. So at this level, it looks like the C Corp might actually be best for you because you get that flat 21%. In between the 315,000 and 415,000, your income is your deduction is phased out based on how far above you are above the threshold. Let's take a look at a specified business example. So here I have checked that I do want this to be a specified business. And you can see this is exactly the same example I had previously. 50,000 in wages, 1 million in assets for the test. So I already changed that, just like I did previously. And we can see that on the individual income tax side, we have a little break of 1,484. However, because of the wages we paid, there was an increase in payroll taxes of 3,825. So that's actually, and that means you actually end up paying more if you include payroll taxes in the amount of 2,340. And you can see here that you don't get any QBI deduction. So once you exceed that threshold as specified business, the C Corp test becomes even more essential for you. So let's do the C Corp test. Say, yes, I want to test from S Corp to C Corp. Let's see what happens. Whoa, look at my tax liability. It goes down $22,698. As a specified business with very high income, I mean, even at that income level, I think most people will agree that $22,000 is not a pocket change of money. So it might be worthwhile looking at a C Corp because the 21% tax rate is lower, more than likely lower than what you're paying on your personal side. If you're interested in this Excel file, you can download it by clicking the link below. But in the meantime, just let me know what you'd like me to talk about next. Just leave your comment down if there's any issue that's bothering you that you'd like to see me make a video on. Go ahead and leave a comment for me. Also, if you like the content, be sure to subscribe so you get an alert when a new video is posted. And if there's any general comment you have, how I can improve things, go ahead and leave a comment. I look forward to reading your comments. Thank you.